Welcome to this video on day trading versus swing trading, which is the best. All right, let's get right into it and do some comparisons here. So first of all, let's define our terms. I define day trading as getting in and out during open outcry hours. So that means you're totally flat by the time the market closes. And for that, we're using intraday charts. Now, for swing trading, generally swing trading means holding for about 2 days to 14 days. I use daily and weekly charts when I'm swing trading, which is a little different than some people. Some people use long-term intraday charts, and so they might hold just for 2, 3, or 4 days, and that's pretty traditional swing trading. For me, I do it a little differently. I use daily and weekly charts, and the primary reason I do that is because I'm also day trading, so I don't want to have to look at my swing trades while I'm day trading. So I might hold my swing trades for, I would say on average, about 5 to 30 days. All right, but again, that depends on the time intervals that you're using on your charts. Now, one of the advantages that is highly touted for day trading is they say, well, there's no overnight risk. And that is great, isn't it? That's fantastic, because overnight risk can really mess up your account. And by that, I mean, news coming across the wires on either the company of the stock you're trading, or it could be economic news, political news, market news, whatever. And if you are in a position overnight, then, well, it can really damage you. For example, when you're right before Christmas, of all times, I was holding a tech stock. I was swing trading that, and it went down 50% overnight. I woke up the next morning, checked my position, and it was down 50%. I lost half my money overnight. Okay, why did that happen? Because I was stupid, frankly. I didn't understand how to manage my money and manage my risk. So I still swing trade, but now I learned something, that I don't like that exposure to overnight risk. That can really, really mess you up. So now when I swing trade, I hedge with options, because a protective stop is not enough. I had a protective stop in, but it went right through that protective stop because it happened overnight. So now there's also a benefit of that overnight risk that a lot of people don't talk about. They just say, oh yeah, overnight risk, eliminate that, and that's why day trading is better than swing trading. Well, again, you can minimize that with hedging, but then also remember there's an upside to that overnight risk. If the market goes up 50% in the direction of your trade, well, that's something you just can't get with day trading. So you can get these big high profits with swing trading overnight as well. Just depends on which way the market moves, in your favor or against you. Now, day trading requires a good attention span. So a lot of which one is right for you is going to be psychological. So we go back to the old adage, know thyself. A lot of these are going to be that. It's not that one is better than the other, but one might be better than the other for you, for your mindset. So if you have a good attention span, you can sit there and focus on the markets, you've got to watch the market tick by tick, bar by bar for day trading, then that can be great for you. You may not even be able to do it for 6.5 hours a day, and you don't have to. A lot of people who day trade will only trade for maybe an hour or 2 or 3. And in fact, that's what I do now. I only trade for 2 to 3 hours a day when I'm day trading. And if you can focus for that period of time, then you're golden. With swing trading, you don't really need to be sitting there watching every single tick in the market. So a great attention span is not as required. Now with day trading, you may need a larger account if you're day trading stocks. So I'm not going to go into it a lot here, but ask your broker about the pattern day trading rule. Look it up online, but it'd be best to talk to your broker about it. So a lot of times you'll need $25,000 account in order to do day trading if you fall into the pattern day trading rule. At least that's here in the US. So there's ways around that, of course. You could be day trading futures or day trading Forex, and there's different rules for that. So in that case, you can actually have a smaller trading account if you're trading those markets. So the irony is that it is also possible when you're comparing with futures or Forex, you might need a larger trading account if you're going to trade stocks with swing trading, because the risk that, at least the way that I trade, the way I define my maximum risk per trade is based on the range of the bars. And on a daily chart, which is what I use for swing trading, that range is a lot bigger than the range on an intraday chart, and therefore the amount of money I have to risk is larger. So I would need a larger account. So these are, things you have to look at depending on the market that you're trading and what your money management rule is. My money management rule is I won't risk more than 2% of my trading account at any one given trade. So to keep the risk minimal down to 2%, I've got to have a bigger account in order to do that. Now, a lot of people talk about stress and say day trading is more stressful than swing trading. And it can be. It can be. So if it's stressful for you to sit there and watch every tick of the chart come through, then please be aware of that. And again, that's a personal thing that you need to take into account. On the other hand, though, one thing people don't talk about quite as often is that overnight you have peace of mind. So when I had my account drop 50%, not actually my account, but that one position on that one tech stock dropped 50% overnight, that did not give me peace of mind. That was really, really shocking. I didn't have a good day that day. So then all of a sudden I started worrying about holding positions overnight. And even before that, I didn't really acknowledge it, I guess. I didn't have an overt fear of it, but even at night, I would be thinking about my positions that I was holding overnight. And so it may not lend itself to sleeping well. Day trading, your positions are all closed, you're good, and you can sleep well at night. So swing trading may be less stressful during the day, but again, overnight, it's possible you might have trouble relaxing if you're not watching your positions. And again, that's more of a personal thing. Best way to overcome that, again, is, in my opinion, hedging with options. So, take a little break here. This is not really an ad. This is an offer. I am giving away my free market entry cycle indicator. I'm going to give you that for free for being on my YouTube channel. And just email me at barry@topdogtrading.com. I'll be happy to send you information over about that. All right, getting back to our topic for today. By the way, the email is still down there at the bottom left-hand corner if you need it. Now, this one is not as subjective as some of the other pluses and minuses. So for day trading, you definitely need better technology. You've got to get, there's a thing called FIFO, first in, first out. And that's really important, not only for your entries, but also for your protective stops. You want your stops not resting on your computer, not resting on your broker's computer, but you want them resting at the exchange. So you've got to have that technology through your broker. You've got to have a great computer that is fast. You've got to have a fast internet connection, great software, great execution platform. So you've got more overhead costs, and you've got to take all that into consideration. Swing trading, not so much. The precision of your entries isn't as influential on your P&L. And you can do your swing trading from mobile devices and things like that. So that is a very clear, just black and white objective difference. Another one is that mentally, with day trading, you got to be quick on the draw. That means you don't have a lot of time to make decisions, analyze the charts, think about it. No, when those setups come on, if you are trading on a short-term time frame, you got to just make a decision and execute right away. With swing trading, no, you got a lot of time. You can take hours if you want to analyze the charts and any other factors that you need to make a decision in a more relaxed manner. Now, with day trading, and here's another very practical aspect, is that you can't do day trading during your day job, especially if you're trading the equity markets in your area. So now you can get around this one too. There's always a way. There's a lot of ways to get around some of these common problems. So, for example, if you really want to day trade, but you have a full-time job, you can look at trading spot Forex, trade currencies that are active in another country on the other side of the globe from you, where the sun is shining and the markets are active over there and you're not working. And another one, like I live on the West Coast, I live in Los Angeles. So here the market's open at 6:30 a.m. And so if I had a job at, say, 9 o'clock or whatever, I could trade for an hour or two before I went to work. And a lot of people only trade for an hour or two when they day trade, and that's perfectly fine. Swing trading, much easier. You don't have to worry about any of that. You could just do it whenever it fits your schedule. And then finally, our last slide here, and this talks about what most people are interested in, which one makes more money. Well, with day trading, I do have to say you can compound your money faster, potentially. All right, I got to add that word potentially. That's assuming everything goes well, which, of course, most of the time it doesn't, just to be totally transparent. But theoretically and hypothetically, if you're making money every day, let's just use that as an example, which most people don't, but then you're adding to your account every day, and your account getting bigger, 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 and that means that then over time, eventually, you can trade larger size, more lots, more contracts, more shares, and then you can continue to increase the size of your trades and exponentially grow your account. And that's one of the big things. Now, of course, it is a two-edged sword. And as we said, things don't always go perfectly. And so if they go perfectly imperfect, you're going to lose money faster as well. So that's the double-edged sword there. And then, of course, commissions. Because you're trading more frequently, you're racking up more commissions. Now, with swing trading, again, potentially you're going to make less money because you're not compounding your account as quickly, assuming success. But you don't have to just trade equities. You can trade options, and options are leveraged. And therefore, that's one way to make up for that and to increase the compounding of your account. And personally, that's what I like to do. So if you like this video, please understand that, sure, it's free, but I'll tell you what. I'd love to make this a little community project. Why don't, if you have some ideas of why you like swing trading or day trading better, or you can think of some things I left out, or you disagree with something I said here, or you want to add a nuance, add it into the comments down below. Let's help each other out here. Make this a little community project and tell us why you think day trading or swing trading is better or worse, or some of the factors that need to be considered. I'd really, really appreciate that. And you'll be helping other people as well. And then go ahead and click the share button below and share it with other people so that we all benefit from it. Also invite you to click the thumbs up icon below and leave any comment that you might have. I'm giving away one of my favorite trade strategies. It's called the rubber band trade and has a very, very high win-loss ratio. So it's a simple trade. I'll teach you to in about 26 short minutes on a video, which you can get by clicking in the image in the top left corner, or if you're on a mobile device, click on the little eye with a circle around it in the top right corner of this video. And if you're not watching on YouTube, there's probably a link below or an opt-in form on the side. Once you do that, I will personally email the video to you with the rubber band trade strategy.